In 2000, gold was 253 bucks an ounce. Now it's 2,700 bucks. It's moved at 8% compounded for 24 years. Uh, this year was just playing catch up. That's all it was about. Really, nothing has changed, Chris. Uh, the market share of precious metals and precious metals related assets in the United States relative to other savings and investment classes is only one half of 1%, which is to say less than one half of 1% of total savings and investment assets in the United States is denominated in precious metals and precious metals related assets. The 4-decade mean is 2%. The gold bugs say, the treasury market's going to implode, the dollar's going to go to zero, gold is going to replace US dollars. That's all horseshit. That's all horseshit. And it doesn't have to happen. If the market share of precious metals reverts to mean, which is what I think is going to happen, and I think it's going to happen over the next 5 years, demand for the stuff increases fourfold. Fourfold. Now, people ask me for price, targets. I have no earthly idea, and I couldn't care less about information that's irrelevant. All I can say is if demand increases fourfold, it's going to have an impact on price. I can also say, in direct answer to your question, I don't know why, but in prior gold bull markets, the market has been led by gold. At a certain point, when gold establishes the momentum and the generalist investor buys the precious metal narrative, leadership switches to silver, and silver rises further and faster than gold. When will that occur? I have no earthly idea. Will it occur? I'm 100% confident that it will.
Okay, and interesting what you mentioned there. I think you made clear your feelings on whether we're going to have an implosion of the dollar or something of that nature. What do you see, perhaps if we went 10 or 20 years out? Obviously, we have the debt growing. It seems like it's not going to get repaid, and some flaws in the system. Certainly, the degree to which they could paper that over for longer than we think is possible is lesson hopefully we've learned the last couple of years. But what do you think ultimately happens with this?
Well, I'm 71 years of age now. I'm a very healthy 71-year-old. I think I'll be graced with many more years on Earth. And I think the US dollar will be the world's reserve currency for the rest of my life. I think the hegemony of the US dollar will be called into question because of the idiotic imposition of US policies, the weaponization of the US currency. But I think, to quote Doug Casey, the dollar is the worst currency in the world, with the sole exception of all the others.
Yeah.
So I think the dollar will continue to do well if you measure it against other fiat currencies, which will do less well. But I think for Americans or for foreigners who have chosen to denominate their lives in US dollars, that the maintenance of purchasing power in the US dollar will increasingly be challenged, not relative to the maintenance of purchasing power in Canadian dollars or euros, but in an absolute sense. And I think it's important for your listeners to understand the reasons why, with the caveat that it might be boring. It's arithmetic, not narrative. The measurement that people use in terms of the deterioration of the purchasing power of the US dollar is the CPI. That's the stated rate of inflation. And it's fiction. It's absolute fiction. They suggest to you that CPI as a measure of inflation, and maybe it is defined inflation, but it's no measure of the decline in purchasing power. Your listeners need to ask themselves, in the last 4 years, since 2000, where the CPI stated rate of inflation has varied between 2.4 and 2.7%. So let's call it 2.5% compounded. What's happened to the price of gasoline in 4 years? How about healthcare and health insurance? Mortgage interest rates have doubled. The price of groceries is a political issue. And of course, the CPI doesn't include tax. Have your taxes gone up in 4 years, Chris?
Yes.
I would suggest to you that for the basket of goods and services consumed by Chris Marcus or Rick Rule, that the purchasing power of the US dollar is declining by about 7.5% compounded. Here's the crux for the dollar. If they're paying you 4.2 in the US 10-year Treasury in a currency that's declining by 7.5% a year, your savings are costing you. It is in circumstances over time where investors are concerned about the maintenance of their purchasing power in fiat instruments that gold does well.
Yeah.
If you look at the period 2000 to 2024, gold has kept pace with the deterioration of the purchasing power of the US dollar. One could say that gold isn't up from 253 to 2,700. One could say that gold hasn't increased in price sevenfold, but rather that the dollar has deteriorated in terms of purchasing power sevenfold. And I think what you saw this year is the beginning of the realization, just the beginning of the realization of that calculus.
Yeah, I think that's well put, especially the way you phrased it, where, and I agree that the dollar as the reserve currency probably going to go on a lot longer than many, including myself in the past, have said, although as it remains that reserve currency, what it's buying in terms of goods, obviously we know how that's going to go. So with that said, Rick, there's something I've been wanting to ask you for a while because this actually goes back to the silver squeeze in 2021, amazingly, almost 4 years ago now. And obviously a lot happened there, although what I found particularly interesting, you were running or involved with the PSLV trust back then, and I heard a couple of interviews where you mentioned that, initially it was more just the retail product that got caught offside on that one weekend. Yet later, as more money kept coming into PSLV to fill the demands, because you can't have, well, the metal's coming or it's over here, we're going to get it. And you talked about how you cleared out a couple of different cities of their silver supply. And perhaps we could start there, and then I might have a couple questions to tack on.
That was an interesting experience. I had anticipated that the silver market was broad enough that it could accommodate our demand in almost any size. And while the silver market is very, very, very broad, the silver market was then, and I would suggest is today, much more liquid, or much less liquid than you believe. While there's a lot of supply in places like private ownership by the Indian peasantry, that isn't good delivery silver. And in the case of the Sprott Physical Trust, we could only buy silver that was, in the LBME or in the COMEX good delivery form.
Right.
And we were having days when there was $50 million of inflow into our physical silver trust. No problem, says Rick. We clean out Toronto. Okay. We go to Montreal. Clean out Montreal. Interesting. Well, no problem. We go to Chicago. We clean out Chicago. This is becoming concerning. The market's front running us. We go to New York. We clean out New York. It turned out that London was ultimately able to accommodate us. But London wasn't able to accommodate us overnight, which is what we were used to. We were used to buying silver and having the silver go from somebody else's pile in a vault,
Right,
through a screen to our pile in a vault. What happened was that we cleaned out all the piles until we ran into the final piles in London and Zurich, which accommodated us. I actually think that the young adherents to the silver squeeze were onto something. I think their problem was that they bought a long-term narrative and they took in short-term tactics. I actually believe that there are imbalances in the silver market, in particular between the physical market and the paper market. And that's what we ran into.